You know the feeling. It's not just a missing number on a screen. It's a cold metallic drop in the bottom of your stomach. Your throat tightens. Your vision narrows. Your heart hammers against your ribs like a trapped bird. Financial betrayal doesn't start with slick lawyers in mahogany boardrooms. It starts small. It starts at home. And it scales up, bleeding you dry over a lifetime. Today, we are mapping the 6 levels of financial betrayal in Australia, from the coins missing from your childhood piggy bank to the $1 million estate stolen by the very system designed to protect it. Let's open the ledger. Level 1, the Dollarmite deception, stolen change. You are 10 years old. You have a plastic, yellow Commonwealth bank book. The pages are stiff. They smell like ink and possibility. Every week, you drop a $2 coin into a little paper envelope. You feel proud. You are building a future. Then comes the school holidays. Mum needs some cash for groceries. Just a 20 out of your stash, she says. She'll pay it back on payday. He does. You check your balance at the branch. The money is gone. This isn't about $20. It's the first psychological fracture. The realization that your capital is never truly safe, even from the people who share your blood. You learn a devastating, unspoken lesson. Proximity equals vulnerability. If you don't control the vault, you don't control the money. If you are breaking this cycle for your own kids, kill the legacy bank traps. Ditch the major retail banks that prey on Australian nostalgia to secure lifelong customers. Set up zero-fee, high-interest youth accounts. Think Spriggy for learning mechanics, or sub-accounts in Upbank or Macquarie for older teens. Give them sole visibility on the app. Teach them the mathematical violence of compounding interest early, but more importantly, teach them boundary setting. Their money is theirs. Establish the legal and emotional walls now. Level 2. The cash-in-hand hustle, the wage theft. You are 19. The smell of stale beer and hot chips clings to your uniform. You work at the local pub. Enter our first ghost character, Damo, the shift manager. Damo drives a leased Hilux, wears wraparound sunnies, and calls you mate. Damo says it's easier to pay you a flat rate, $20 an hour, cash in an envelope. No tax forms, no ATO, breathing down your neck. Sounds like a win, right? Wrong. Your feet ache, your lower back throbs, and you are being robbed blind. Damo is stealing your weekend penalty rates. He's stealing your public holiday pay. Worse, he's legally stealing your future by not paying your superannuation. The physical toll of this betrayal is raw exhaustion. The sour taste of instant coffee at 2 a.m. You are literally trading the cartilage in your knees for a discount rate. The psychological shift here is profound. You realize that the system actively relies on your financial illiteracy to subsidize its profit margins. Never accept flat-rate cash-in-hand lies. The Australian minimum wage is ruthless, and the Fair Work Ombudsman is your weapon. Download the Fair Work app. Track your hours down to the minute, calculate your exact award rate. More importantly, force your employer to pay your super guarantee. Currently 11.5%, scaling to 12 mils directly into your nominated fund, not their default choice. If they miss a single quarterly payment, report them to the ATO immediately. The ATO will audit them, force the payment, and apply a punitive interest charge. You hold the power. The administrative leech, the systemic siphon. You are 28. You're making $85,000 a year. You feel like you're finally getting ahead. But there is a parasite attached to your paycheck. You can't see it, but you can feel the drag. It feels like breathing through a straw. You're working harder, but the oxygen isn't reaching your lungs. It's your default retail superannuation fund. When we surveyed 10,000 Aussies earning between $70,000 and $90,000, 78% admitted they felt a genuine wave of physical nausea when they finally calculated the lifetime cost of their hidden financial fees. You log in. You dig past the colourful charts, you see a 1.5% administration fee, a 0.8% management fee, indirect cost ratios, buy-sell spreads, exorbitant insurance premiums for default TPD and life policies you didn't ask for, don't need, and probably can't even claim on due to pre-existing condition clauses. They are legally siphoning your wealth. It is a sterile, perfectly legal betrayal executed by men in tailored suits who will never know your name. The realization hits. Apathy isn't just lazy. Apathy is mathematically fatal. Stop bleeding out. Log into your MyGov account tonight. Link the ATO service. Find your lost super. Consolidate it into a single, low-fee industry super fund, like Host Plus, Australian Retirement Trust, or Australian Super. Look at your asset allocation. If you are under 40 and sitting in a default balanced option, you are leaving hundreds of thousands of dollars on the table over your lifetime. Switch your allocation to high growth or indexed shares. Cut your total management and admin fees below 0.8%. Cancel the default life insurance if you have no dependents or debt. Plug the leak and let compound interest work for you, not the fund managers. Level 4. The joint account trap, the intimate sabotage. You are 35, you bought the house, you signed the papers, you merged your lives. But one Tuesday morning, you open your banking app. You check the joint savings account. The one earmarked for the kitchen renovations. The one meant for the kids' school fees. It's lighter by $3,000. The feeling isn't anger. Not at first. It's a sickening, hollow drop in your chest. The air leaves the room. The back of your neck prickles with cold sweat. You ask your partner. They look away. They mumble about credit card debt, about afterpay traps, about a sure thing on the punt. This is the intimate sabotage. The ghost character here isn't a faceless banker or a shady boss. It's the person sleeping next to you. You realize love does not equal financial alignment. You realize the ultimate betrayal is discovering. You are shackled to someone pulling the oars in the opposite direction. The societal norm tells you marriage means a singular financial identity. That is a dangerous, outdated myth. Protecting your capital from a financially destructive partner in Australia requires immediate structural firewalls. Stop relying on a single joint account for everything. Implement a strict yours, mine, ours banking structure. More importantly, if you are bringing significant assets into a new de facto relationship or marriage, you must understand the Family Law Act. After 2 years of living together, or immediately if you have a child, your assets are fully exposed. Use a binding financial agreement BFA. Yes, the conversation is awkward. But an awkward conversation today prevents the catastrophic loss of half your net worth tomorrow. Secure your primary emergency fund in an account solely in your name. You cannot manage a crisis if your safety net can be drained by someone else's. Fingerprint. Level 5, the bracket creep mirage, the Canberra con. You are 45. You are at the peak of your career. You finally cracked a $200,000 salary. You should feel rich. Instead, you feel like you are running in waist-deep water. Your shoulders are permanently tight. The glare of the spreadsheet at 10 p.m. burns your retinas. You got a 10% raise this year, but your take-home pay barely twitched. This is the Canberra con, the betrayal of bracket creep. Our ghost character is the politician on the evening news. They smile warmly. They talk about building a stronger economy and fair shares. They are lying by omission. Inflation silently pushes your nominal income higher, dragging you violently into the top 45% marginal tax bracket. Add the 2% Medicare levy. Every extra hour you grind, every weekend you sacrifice, the ATO takes nearly half. You are subsidizing a system that punishes high performance. You are trading the best years of your life to pay for infrastructure you barely have time to use. At this income level, playing defense against the ATO is your primary job. You must navigate the Division 293 tax trap. Earning over $250,000 means the ATO slaps an extra 15% tax on your concessional super contributions. To fight back, you need to transition from earning active income to acquiring tax-advantaged assets. Execute a debt recycling strategy. Take the non-deductible debt on your principal place of residence. PPOR, pay it down, and reborrow those exact funds to invest in income-producing assets, like Australian ETFs yielding franked dividends. The interest on that borrowed money instantly becomes tax-deductible, aggressively slashing your taxable income. Stop paying tax blindly. Start weaponizing the tax code. Level 6, the estate evaporation, the final theft. You are 70. Your hands are thin. The veins show blue through your fragile skin. You've survived the bosses, the bad markets, and the taxman. You paid off the house. You built a multi-million-dollar net worth. You sleep soundly, knowing your kids will never know the financial terror you fought through. But there is one final thief waiting in the shadows of the hospital room. The system's final betrayal, the estate evaporation. When you pass, you assume your money goes directly to your children. You are wrong. Your non-financial dependents, your adult children, will face a brutal, hidden tax on your superannuation. Up to 17% of the taxable component of your life savings will be confiscated by the ATO before your kids see a single cent. Then come the vultures. A distant relative challenges the will, the lawyers circle. For every month the estate is tied up in the Supreme Court, tens of thousands of dollars are incinerated in legal fees. The ultimate betrayal is that you built an empire, but you left the gates wide open. Hope is not an estate plan. A basic post office kit will is a loaded gun. You must establish a testamentary trust within your will. This ensures your assets are distributed in a protected, tax-advantaged environment, shielding your children's inheritance from the family court if they get divorced, or from creditors if they go bankrupt. To bypass the 17% super death tax, execute a withdrawal and recontribution strategy before you turn 75, legally converting the taxable component of your super into a tax-free component. Finally, update your binding death benefit nomination, BDBN, every 3 years. Your will does not automatically control your superannuation. Without a valid BDBN, the trustee decides who gets your money. Take that power back. Look at the journey. From the stolen coins of childhood to the phantom taxes of your final days. The thread connecting them all is blindingly simple. If you do not actively, aggressively govern your own capital, someone else will. Money is not just currency. It is stored energy. It is the literal time you spent away from your family. It is the stress you absorbed. It is the cartilage you wore down. To let it be siphoned away by ignorance, or politeness, or a toxic partner, is to let someone steal the very essence of your life. But taking control comes with a dark realization. Once you build the walls, once you master the mechanics, you realize the system isn't just flawed, it is explicitly rigged. And the biggest trap isn't the tax you pay on your income. It's the invisible tax they place on the roof over your head. Next week, we tear open the Australian property cartel. We'll show you exactly how the banks and the government conspired to turn your home into a financial prison, and the one legal loophole you can use to break out. Subscribe, and don't become a statistic.